Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over Texas Instruments earnings report, in which they just reported their earnings after the bell today, and the stock is definitely not performing well. The stock is down a pretty good margin after this disappointing earnings report. So we're going to be getting into this earnings report, we're going to be diving into that, and then we're going to be going into the fundamentals of the company, and then we're going to be seeing if we should be buying after this big dip in Texas Instruments stock. So let's get into this earnings. And like I said with Texas Instruments here, I said the stock is not doing well, and as we can see, the stock is down over 7% after hours after this earnings report. So the stock is really not doing well. Investors did not see this as a good earnings report, and if we take a look at the earnings here, we can see actually revenue increased 7% sequentially, so quarter over quarter, and 14% from the same quarter a year ago. So they're actually growing at a pretty decent rate. 14% is some solid growth year over year. Also, cash flow from operations of $6.9 billion for the trailing 12 months underscored the strength of our business model, the quality of their product portfolio, and the benefit of 300mm production. Free cash flow for the same period was $2.4 billion. So the free cash flow looks very strong year over year. Also, over the past 12 months, they invested $3.9 billion in R&D and SG&A, so acquisitions, and invested $4.8 billion in capital expenditures, and returned $6.6 billion to owners. So they're returning a lot of money back to their owners. Also, the fourth quarter outlook, let's just look at this quarter first. Taking a look at for the 3 months ended of September 30th, the chipmaker reported adjusted profit of $1.48 per share on revenue and 4.7. Taking a look at the third quarter earnings report here, as we can see, during the first 3 months ended September 30th, the chipmaker reported adjusted profit of $1.48 per share and revenue of $4.74 billion, compared with estimates of $1.49 and $4.65 billion respectively. So the EPS came up slightly short, but the revenue did come in pretty strong. So looking ahead to fiscal quarter 4 earnings, the company expects earnings per share in a range of $1.13 to $1.39, which this is the big problem with this earnings, missing analyst estimates for $1.41. So in the midpoint of this earnings report, it was about $1.25. So they really reduced their guidance for this upcoming earnings compared to what analysts expected. So that does not look good for Texas Instruments. Also, the revenue was guiding a range of $4.22 billion and $4.58, which was a midpoint of $4.4 billion, but missing analyst expectations of $4.51. So the reason the stock is down is most likely due to this guidance coming in pretty poorly for both the earnings per share and revenue for next quarter. Also, taking a look at the segment performance, analog revenue saw growth of nearly 16% year over year to $3.73 billion, which was better than analysts expected, while the embedded processing revenue rose only 9% to $709 million, which was below analyst expectations. So the analog revenue did beat, however, the embedded processing revenue for Texas Instruments did not. The cash flow from operations was very strong, like we said, $6.9 billion, and obviously the guidance was not very good, like we said. But if you don't know what Texas Instruments really does, Texas Instruments is a global semiconductor company that designs, manufactures, and sells analog and embedded processing chips. These chips are essential components for almost all electronic systems. And take a look at what the analog area is, which is their largest segment, like we saw with the revenue of over $3 billion. Analog chips work with real-world signals like sound, temperature, pressure, or images by conditioning, amplifying, and often converting them to digital data for processing. Products include power management circuits like battery management, regulators, drivers, and also signal chain products, amplifiers, data converters, or sensors. And the other segment that Texas Instruments is in is the embedded processing, which the chips are essentially small computers designed to handle specific tasks, offering core control and processing in electronic devices. So these are the two product business segments of Texas Instruments, and the analog segment did pretty good, so that's a check, but the embedded processing was not as good as expected. So if we go over to market-io, let's type in Texas Instruments. Let's take a look at Texas Instruments SWOT analysis, which can show us the strengths, weaknesses, opportunities, and threats that I really like to look at. So taking a look here at the strengths for Texas Instruments, we have dominant analog semiconductor leadership here. So the revenue continues to grow very well with the analog semiconductors. This had 13% year over year growth. That actually did go higher, which was at 16%. So the analog revenue is growing very good, so that looks good. Also, in-house manufacturing infrastructure is very strong for this company. Strong free cash flow, like we said, and they're returning a lot of money for the shareholders. So with their dividends and buybacks combined, they've returned almost $7 billion in the last quarter. This is $6.4 billion over the trailing 12 months, but in the last quarter, for the full year from last quarter, they did very good that they just reported. Also, diversified industrial and automotive demand looks very good, and the resilient business model with high margins. However, weaknesses are the margin pressures from expansion costs. They're spending a good amount on their capital expenditures, $1.1 billion here, so that it might be a problem. Also, geopolitical risk in China. Most of these semiconductor companies are having some problems with China and has led to decreasing revenue in that segment. Cyclical demand also is a potential worry with this company, and this company is very cyclical. Most semiconductors are cyclical, and with Texas Instruments, we will see that in their revenue. Also, supply chain vulnerabilities is a problem in very competitive environment in semiconductors, and the opportunities here is the AI-driven demand growth, government incentives and CHIPS Act. They have also diversified market growth, IoT and embedded processing recovery. All this is very good. Also, like we said, the shareholder return is very good with how much money they're returning to the shareholders. But the threats are the geopolitical trade risks, like we said, with 19 to 20% of their revenue exposed to China. That could be a problem with the tariffs. Also, margin compression is slightly worrying, and segment concentration risks. So if we go down here, taking a look at the hedge funds and institutions, 57% are bullish on this company, only 43% bearish, so at least the majority is bullish, so this looks pretty decent for Texas Instruments. So if we go over to my valuation investing website here, and we go over to the stock analysis tool, if you want to go check out this website, just go down in the description, or look up valuationinvesting.money. You can get a 7-day free trial for free, and then you can also it's only $8 per month for this entire website. You get a bunch of things like the portfolio tracker, every single stock on the market, stock analysis, and an intrinsic valuation. So I really like this, and I personally use it even on my own, and not just for the videos. So I really like it for my own analysis too. So if we go over and take a look at the Texas Instruments 7 key metrics here, this looks pretty rough. Forward P ratio is an X at 30.755. Return on invested capital is barely a check mark at 10.9%. The growth numbers look very bad, negative growth rates. That is what I'm saying about the cyclicality of this business. It's very cyclical, so you're not going to be able to predict it as well as, say, a Microsoft or a Google. Those are very consistent companies, but in the semiconductor industry, it's much more cyclical and hard to predict the future. Shares outstanding are at least decreasing. They're buying back. Debt to free cash flow is not here, so that is interesting. I don't think that should be accurate, because if we go over to the debt, they have $14 billion debt, and if we go over to the financial data, though, we can actually see they had positive free cash flow. So for some reason, it's showing that there. So this free cash flow, though, however, at only $1.5 billion there in that recent year. However, with this recent quarter, though, this is going to show very strong free cash flow. So with that, let's look here. $1.5 billion in free cash flow. Look at the variability in this free cash flow. And this is what I'm saying with Texas Instruments cyclicality of the business. 2021, 6.2 billion, 5.9 billion in 2022, 2023, 1.3 billion, so a huge drop. 2024, 1.5 billion, and now back up to nearly $7 billion in free cash flow. So this is where you want to be a bit careful with this company, just due to the variability in this free cash flow and revenue in basically every single fundamental area of this company, that you need to be a little bit careful. So with the intrinsic value calculations here, actually, let's go over to the financial charts to get a sense of the revenue. As we can see, revenue just continues to decrease. EPS continues to decrease, so it doesn't look good. Do I think they're going to decrease in the future? Probably not, but I don't expect fast growth out of this company. Even though they grew at a pretty fast pace this last year over year at 14%. Do I think they're going to be growing that fast in the future? Probably not. I'm going to do bear case 4%. Let's do base case 7 and then bull case 10. I think they're going to be growing at high single digits, but I don't think they're going to be growing that fast. Now, for the future profit margin here, their profit margin's at 30%, so it's pretty darn high, and I think it's going to stay right around here. 27% bear case, base case I'm going to do 30, bullish case 33. I don't see it changing that much in the future unless there's some huge cyclicality or a very big boom in Texas Instruments just demand, or even a big bust, but I think it's going to stay right where it is today. For the future P ratio, I expect about a 14 P ratio for the bear case. Base case, I'll put 18, and then bullish case, let's do 22. Now for the shares outstanding, I think they're going to be, let's say, buyback 0.5% bear case, and then bullish case 1%, and then base case 1%, bullish case 1.5%. With that being said, our intrinsic value calculator here, we get negative returns from the base case today. So right now, me personally, I'm not interested in Texas Instruments. Even if these intrinsic value calculators showed almost a 10% return, I just personally don't like the cyclicality of this business. Am I saying that you're going to get negative returns in the future? I highly doubt it. But I'm not interested in this company just due to the cyclicality nature of how this company is. And I just like to have companies that have a huge moat. They're very predictable, and that's just what I like to invest in. So thank you guys for watching this video. Please subscribe. Let's get to 5,000 subscribers by the end of the year. If you want to go check out the Patreon where you can then sign up for this website, click right here. Thank you guys for watching. See ya.